Do you know how a simple savings account metric can fundamentally change the way you think about balancing bonds and stocks in your portfolio? Thinking face. Most investors grapple with the age-old question, how much in fixed income and how much in equities? Traditional advice often points to your age or risk tolerance, but there's a more dynamic, macro-driven approach that uses a metric you might already be tracking, albeit indirectly, M1 money supply. What is M1? Money bag. M1 is the most liquid measure of the money supply. It includes all the physical currency in circulation and the money held in easily accessible bank accounts, like checking accounts. Think of it as the money that's ready to spend right now. When M1 grows quickly, it suggests that there's a lot of liquid cash looking for a home, which often fuels spending and economic activity. When it shrinks, or grows very slowly, liquidity is tightening. The bond equity signal from M1. Here's the powerful connection. M1 can act as a barometer for market liquidity and risk appetite. When M1 is growing rapidly, meaning there's abundant, easily accessible cash in the system, this liquidity often spills over into riskier assets. People have the money to invest and are more willing to chase returns. This typically favors equities chart increasing. A fast-growing M1 environment often correlates with periods of strong stock market performance, as investors are flush with cash and optimistic. Conversely, when M1 growth slows significantly or even declines, it signals a tightening of liquidity and often an underlying economic slowdown or increased market uncertainty. In this environment, investors generally become more cautious. They seek the safety and stability of fixed income. This is where bonds often become the preferred asset class. Applying the rule bar chart. This isn't about perfectly timing the market, but about adjusting your allocation at the margin. Consider using a rate of change for M1, perhaps on a year-over-year basis. High M1 growth, e.g., above its 5-year average. This environment suggests a lean toward equity overweight. You might shift a few percentage points of your portfolio from bonds to stocks to capture potential upside from high liquidity. Low or declining M1 growth, e.g., below its 5-year average. This signals a liquidity crunch and potential risk. Here, you'd consider an equity underweight and increase your allocation to bonds for capital preservation and stability. It's a simple, yet elegant macro signal that helps you move beyond static allocations and use the dynamics of the money supply to inform your portfolio decisions. It helps you recognize when the economic tides are shifting from risk on to risk off. With that said, thanks for watching, and until next time.